Now, our next question is a little bit open-ended, but you've served many clients of family law attorneys in a consulting capacity, including but not limited to reviewing and analyzing tax returns for purposes of discovery, what assets exist, but also to negotiate property division. When you're analyzing tax returns for the non-property spouse, what are some of the things that you look for?
Well, the one that's classic, and any reasonably competent family law attorney would know this, and I'll set up an easy straw man argument to illustrate the point. Let's say that one of the spouses has, say this, the man, he has a business and he's got a wife and they're getting divorced because he has a girlfriend. Now, I know this has never ever happened before in reality, but it is reasonable to assume that said girlfriend is at least some sort of an expense in that business. So now she may not can type. If I can go way back into the annals of political history of secretaries being on the payroll who never typed, but good tax planning would be to put such paramour on the payroll, and therefore taxes are being saved, and she's compensated for her services, of course. And then the other spouse, let's just say the estranged wife here, when you're calculating child support or alimony, the income level has been reduced for the offending spouse, and it doesn't turn out well. And I would say that for people who have discretion in their businesses to employ who they wish, more likely than not, this happens. And it may not be having one's paramour on the payroll. It may also be simply running what I kindly refer to as lifestyle expenses through the business. Now, it may be a completely allowable an expense to the business regarding the Internal Revenue Service, but the other spouse may object that they ran through a $400,000 Rolls Royce through the business. This actually happened a few weeks ago with a client of mine. And this is not my typical clientele, but this one is a rap music producer who came to me with the question that he was buying a $400,000 Rolls Royce, and then he was spending $100,000 on a custom purple and gold paint job for such Rolls Royce, not so that he could drive it around town and be shot, obviously, but so when he stepped out of the car at the Grammy Awards, that he would have a presence in a purple and gold Rolls Royce. Now, the Rolls Royce, and he asked me, could he deduct it? The answer is yes, fully, 100%, a $500,000 business tax deduction. However, let's just add that this person might be in the process of a divorce. Do you think his wife would like, for purposes of alimony or child support or division of assets, to allow him to have a 500,000 reduction of his income for a purple and gold fully deductible Rolls Royce? She might object to this. So, so don't assume that just because something is on a tax return, and do not assume that the opposing side's tax advisor fully assures you, maybe even shows you an IRS examination report, that it was perfectly allowable. It may be perfectly allowable for tax return purposes, but if I was the counsel for the other side, I think I might challenge that. Miles, I don't know about you. You've done this a little bit more than I have, but a purple and gold Rolls Royce at the Grammys probably would be Exhibit A.
Could be, could be. But it also depends on the size of the estate. And
This would be true. This
if
would be
the
true.
estate is meaningful, I know you and I have both seen estates where $500,000 may not be meaningful to any calculation in the divorce, especially when I always tell the story if, you have a tech billionaire and they own a bunch of real estate in a foreign continent, the value of that real estate may not even be relevant to the negotiations.
That would be true. That
Yeah.
would be true.
So that's why it's always great to have, but that would be certainly something I would want to uh, share with my opposing counsel as part of the negotiations, regardless. All right. Any other quick red flags that you would share with the family lawyers who are looking at tax returns?
One thing that I'm beginning to see lately, because I do this frankly in the planning with my clients, is one can create multiple entities and have one entity be charging fees to one entity to move income around. So if a marital law attorney simply gets the 1040, the personal tax return, and they're using that for their documentary evidence of what the income is, they only have maybe about 1/10 of the information they need. They need everything, everything. And now everything may not be fully listed on that personal return. They may have for example, a C corporation, unlike an S corporation or a partnership. It never shows up on the personal return. So therefore, if we're parking income or assets into a separate corporation, uh, may never ever come up. And so one needs to look at the intercompany transactions between these in the same way that many multinationals. I'm speaking of Apple here, and I admire them for this, where they do lots of transactions with low tax countries, particularly Ireland, and so they'll park a lot of Apple's intellectual property in Ireland, and so that the overall corporate tax rate will be less than 5% for Apple. And it's not that it's illegal, it's perfectly allowable for taxation. But one should understand the complete picture of the opposing side in a marital law dispute.
Yeah, and let me just add one little thing on there that I find terribly important is that most family lawyers do not understand the definition of schedules and
Mhm.
attachments,
Yes,
because there are schedules that are included with returns and there are schedules that do not have to be filed with a return but can be. Same
correct.
thing with attachments. Have you run into that in your
Well,
experience?
I run into that like in my own practice. A typical tax return, let's just say what is sent to the client and sent to the Internal Revenue Service, let's say it's a 500-page tax return, which is not unusual in my practice. Well, the full tax return might be 2,000 pages because there are all sorts of supporting schedules that are not required to be attached to it and technically are not part of the return. So that in discovery, if there's a subpoena to send the tax return and the tax return is sent, but that doesn't include the supporting schedules. So they have complied with the subpoena, but still not disclosed all of the information. And so a tax return that I would prepare typically are quite complex. Most of the data is not in the tax return. And it's not that we're committing fraud or a felony or lying or being untruthful. It's simply not required. And if something is not required to be disclosed, why would one disclose it?